Hey, Bulls and Bears, back with another dose of economic reality. It is still December 13th, Tuesday, 2022. Recording this later in the evening. You might be watching this on Wednesday, December 14th. Either way, the news is going to be very, very current. We've got the latest numbers on the automobile loan delinquencies. We're also going to talk about the rising inventory in the housing market. Let's start here with the automobile news. Over 500,000 Americans are 60 days or more late on their car payments. Over 500,000 Americans. Auto loan delinquencies hit a decade record high as loan protections came to an end. And that's what we always try to put out here. How much worse would this be without all the rescue programs? Can you imagine? It might be homeless people on every corner if it weren't for all the rescue programs. And people without heat, people without utilities. We talked about the 20 million households a couple reports ago. How much worse would it be? It's amazing. It could be many people not even surviving because of the cold, and in the summer without the heat because they can't afford their utilities without these programs in order to keep people from freezing or from burning up. Expensive new cars are tough to swallow. The price of the average new vehicle hit $48,000. We are seeing some price declines, but the levels that these prices have reached, it's almost as insane as what we're seeing in the housing market. And we have a long ways to come down. The average used car price, $31,000 at the peak. We're seeing prices come down very slowly, but we are seeing car dealers not cut prices as much for the cars they're selling as much as the price cuts are happening in the wholesale market, right? So auction prices and wholesale prices of vehicles are dropping a lot more than than prices dropping at the dealers. So the dealers are still trying to eke those profits out because a lot of them bought cars earlier this year before prices really started to drop. So even though wholesale prices are coming down very rapidly, we're not seeing so much price drops in at the car dealers. You know what I'm saying? So we're going to keep an eye on it for you. According to the latest data from TransUnion, about 200,000 people took advantage of the auto loan accommodations during the early days of the pandemic. That's a lot of people, folks. The 500,000 people or so that are more than 60 days behind, 60 days or more behind on their automobile loan payments, that represents an uptick, an increase of almost 31% from last year. I'd say that's a pretty big jump, wouldn't you? 31%. And we're just getting into the meat of the layoffs and the job losses. And some people that I see in comments say, well, look at the jobs numbers. How do we add this many jobs? What was it, 260,000, I believe, in the last report? How do we add this many jobs, JJ? What are you talking about? The economy's doing good. The jobs number came in better than expected, better than the experts expected. First of all, the experts are not experts. They're put out there to kind of manipulate the news, right? So all they have to do to paint a positive picture is say these experts, these unseen people in the background, experts thought it was going to be this, and it came in better. Wow, this is great news. So if they want to have great news, they can just make up a number. They can just have the experts back there that nobody sees say, oh, they expected this, and look, it came in better. And if they want it to be bad, they could say, oh, the experts said this and it came in worse, right? So it's all manipulated, just like the data is manipulated, just like the markets are manipulated. These financial economic numbers can be manipulated to either look good or bad, right? Now, when it comes to auto loans, let's look here at the total. So it's over 3.5% of all borrowers, people that have automobile loans, car loans, over 3.5% of them are now behind. So 500,000 represents about 3.5% of all the car loans that are out there. Not a big number, but again, we're just getting into the meat of the layoffs. Consumers are draining their accounts. They're going and getting money out of their 401ks. They're draining their 401ks, and their checking accounts are dropping. They're going into debt, and I say they, I'm talking about most Americans, not everybody, but about 7 in 10, going deeper in debt. Many people draining their 401ks. People lost money in the markets for the most part. People are going further into debt, running up more credit cards, increases in these areas like we've never seen. So just more evidence, folks, that things are still headed into a very, very dire direction, right? And I don't like getting out here and reporting great news. I wish I could report the opposite. I wish I could say people are paying off their debt, they're getting out of debt, More people are paying off their homes. They're free and clear. Cost of living is coming down. People can retire early. That's not happening. If it was, I would be the first to report on it, and maybe I would smile a little bit more. Maybe the news would be better. But that's not what's happening. People are unretiring. People going to their 401k accounts to survive, just the cost of living. And we're still in the early innings, so we have a long, long ways to go. Let's go ahead and jump over to the housing market here. Let's look at some interesting numbers here. And Wolf Street had a good article, a good write-up on this, how the inventory of new homes is surging. And home builders are trying to get rid of this inventory. They're even offering deals to big investment companies, hedge funds, and the like, of hundreds of homes at a time for a good price. But the investors are also backing away. We saw a 30% drop in investor home purchases from the second quarter of this year to the third quarter. Of course, we're still in the fourth quarter, so we'll see in January what happened here in the fourth quarter. But from the second to the third quarter, a big drop-off in investor purchases of homes. So these home builders trying to unload these homes, they were looking to the investors. If a home builder cannot sell their ballooning inventory of unsold houses to households at the current prices and mortgage rates amid plunging sales, despite aggressive incentives such as mortgage rate buy downs, and that's when they'll give some cash to the buyer to pay towards the mortgage costs, origination costs, and they're buying down the mortgage rate to get a lower rate. And so they're kind of doing the cash out type of thing in order to help the buyers. In order to do that, who are they going to sell these homes to then if that's not working? Companies that rent out homes, they're normally big players. They're backing away from the market. The cancellations of signed contracts has soared. In the Southwest is the biggest number of cancellations, and that's 45% of transactions are canceling, almost half. And compared to last year, it was only 9%. So we're seeing a big back away from the market by the big money institutions, and also just the average home buyer. People are being cautious. Not cautious enough, in my opinion, because I think we have a lot of price drop to go. Now, every once in a while, somebody points to something I said earlier in the year. I said home prices were not going to come down. I said, if the Fed comes in and cuts rates. Of course, they didn't do that. And I'm actually proud of the Fed. Yes, I'm saying this right here, right now. I've been heavy critical of the Fed, very heavily critical. I am proud of the Fed for actually raising rates. And not everybody agrees with that. There's people out there right now thinking that rates should be dropped. Elon Musk came out and said the Fed needs to immediately drop rates to avoid a recession. So I can't predict a manipulated market. I just can tell you what I think is going to happen. And if they don't drop rates, then yes, we're going to see continued weakness and falling prices in the housing market, right? It's pretty simple, right? So when it becomes harder to borrow money, then prices will go down. When it's easy to borrow money, rock bottom rates, money printer go burr, loose monetary policy, then prices go up, right? It's not too hard to figure out. What is hard to figure out is the people that control all this. Are they going to say what they're going to? Are they going to do what they're going to say? And we look at the Powell and what he's saying here. He's saying that the economy's strong. So when you hear stuff like that coming out of Jerome Powell and the Fed, it's very hard to believe anything of what they say. All right. So there you go. Please let me know what you think down in the comments. 32% are buying down the 30-year loan. So they're buying down the mortgage rate on a 30-year loan between 1 and 2 percentage points. So if they didn't have that extra money, that incentive from the seller, in this case the home builders, because we're talking about new homes, how much worse would it be? So there's still shenanigans going on to try to get buyers, to get keys in the buyer's hands that normally would not be able to get them in there. Remember the subprime loans back in the first housing bubble? That was kind of the shenanigans that were done back then. They're still doing it, just not as in obvious of ways right now, right? So we see that the inventory, though, is surging. I'm going to put up a chart right here, right now. New single-family homes for sale. And take a look here. We're not quite to the point at the peak of the first housing bubble, but the number of homes on the market has ballooned to 470,000. You can see to the far right of the chart. That's up 21% from a year ago, and the highest since March 2008. So no sign of things stopping. We're still going to see falling prices in automobiles, falling prices in homes, and people say, yay, deflation, deflation. But it's still going to be more expensive if you have to finance these things. If you're a cash buyer, then it's a win because you don't have to worry about the cost of financing because you're not getting a loan. So cash buyers are the winners here so far, because right now it's still more expensive to own a home now, even at lower home prices. It's still more expensive to own an automobile, even at lower automobile prices compared to what we saw at the beginning of the year because of the higher rates. And that's the way it is, folks. So housing market and auto update here wrapped up in the one here. Hope you guys liked it. Please let me know what you think down in comments about all this, people. Thanks for being here. I really appreciate you being here, supporting this channel. And I want to end this with a couple thank yous for the people that gave me tips. You gave me coffee money, and also the super thanks button that you'll see down below this video. DJ Jojo, thank you very much for the kind tip. Puts a smile on my face every time I see this. Gordon Nash, thank you very much for the kind support. And of course, Blue Steel, back again with more support for the channel. And I want to go back and thank again Sassy for the tip she gave me after my recycling video a couple weeks ago now. That was an amazing tip. Thank you very much, Sassy. Appreciate everybody being here. Big love. Bye for now and peace. Keep stacking.